Well, hello, traders and investors. My name is Roger Scott. I'm the head trader for Wealth Press. Today is June 4th. We got jobless claims today. Got a lot of stuff to talk about it. What do I usually say? Let's get into it right now. So, stock market is slightly weaker pre-open. Investors are looking ahead at the European Central Bank's decision on more monetary stimulus. And we got jobless claims and employment data. Jobless claims, I'm going to give it to you in a minute. I waited for the report to come out, so I already know what it is. I'm going to give it to you in a second, but first let's get into global data. Now, stock market has been rising this week on optimism about possible global recovery from the coronavirus pandemic as more economies open. As a matter of fact, yesterday, Italy and Spain reopened. I believe China reopened. Not for everybody. There's a little issue between Chinese people flying into US, but we don't talk about that for now. European Central Banks is wrapping up a policy meeting today, and analysts say it could expand its anti-pandemic stimulus program more. That would be great. Traders will also keep a lookout on the economy as President Christine Lagarde holding a news conference. U.S. focus is on jobless claims. I'm about to give you that data. A survey from payroll processor yesterday said private employers cut nearly 2.8 million jobs last month, less than the 9.3 million that the economists told investors to expect. That's good news. Economists say it may show a loss of 8 million jobs, which could be a deceleration from April's loss of 20.5 million. On Thursday, a weekly report is expected to show almost another 2 million jobless claims. Oh yeah, in the past week. And one report said service industries contracted by less than economists expected at more moderate rate in April. But again, these numbers are nothing in compared to the jobless claims. Jobless claims and whether the trend is increasing or decreasing, and that's the biggest factor. And many economists and many professional traders, including myself, believe that the stock market rally may be too much too fast. And I actually believe I have a whole different view of this after I looked at momentum levels yesterday. A lot of traders are seeing this as a reversal and a V-bounce to new highs. I'm seeing this as a reaction from the extreme pullback levels that we saw in February. So a lot of traders are seeing this, or a lot of retail traders are seeing this as a new leg up. I'm seeing this as a reaction to what happened in February because of the momentum levels, and they're not looking too great. I actually talked about them yesterday, and I'll talk about them tomorrow. But today I want to talk about news, and I want to give you the hottest industry and the hottest stock and the option for that stock. So today is Red Meat Thursday. So now let's look at the jobless claims. Now, the consensus was 1.79 million. The actual number was 1.877 million. It was on the worst end of the range. That's the negative. The positive is it's much better than the average. The average is near 2.6 million, and we're clearly moving down. As you could see here, the prior number was over 2 million by 2.123 million. Now we're at 1.877. But again, it's getting better. The trend is getting better. But even though the trend is getting better, the number is still out of whack. And that's not positive. That's actually very, very negative. Let's look at the futures to see how they are interpreting this report. Yeah, futures, E-minis down a little bit. The Dow's down 42. E-minis is down. What I am seeing is, let me show you what I'm looking at right now, and I'll explain to you the logic for my trade. If you look at the NASDAQ, this is the NASDAQ 100. If you look at it on a 6-month basis, you will notice that volatility has been moving down and price has been going up. But the last week or so, it's been losing momentum. It's been losing directional bias. And I mean, look at this. We went from 9,700 to 6,600 all the way back to 9,600, where the high is 9,800. We're almost near the highs. The problem is this correction that we saw here was very, very violent. We broke the 200-day moving average, and now we're moving back up. And right now, I'm still seeing, in terms of the S&P 500, about 59 to 60% stocks trading below the 200-day moving average. Let me show you this. This is actually kind of eye-opening. I said I was going to do it tomorrow or yesterday, but I did it yesterday. But let me show you again. It's important. Look, there's only 48% of stocks trading in the S&P above the 200-day moving average, but there's 97% of stocks trading above the 50-day moving average. So the long-term trend is still bearish. We're below 50%. Pay attention. This is really important. But the short-term trend or the medium-term trend is very bullish. So what I'm seeing is, if you look at the momentum levels, sorry about that. If you look at 25-year momentum levels, when we dumped, when the stock market went down, we went all the way down here. Lowest momentum levels, we had literally 2 stocks or 3% of stocks in the S&P 500 trading above the 200-day moving average, 50-day moving average. And then after that, we kind of hovered here for about 2 weeks, and then we went back up, and now we're at the highest momentum level. Lowest momentum level in 20 years, highest momentum level in 20 years. We got 97% of stocks in the S&P trading above the 50-day moving average. And that's technically very overbought. Not only that, we're seeing divergence in the S&P 500. And that's telling me we're going to cool off. We're going to come down. We are overdue. We can't go out. That rubber band is stretched out. And when it does start moving down, you're going to see this number, this 48th percentile decline, and you're going to see the NASDAQ and the S&P 500 move down, and that'll inevitably impact the NASDAQ 100 because the same stocks excuse me, the same large caps are in the S&P 500 are in the NASDAQ 100. The Microsoft, the Nvidia, the Amazon, the Intel, all of those large cap stocks. And they power the NASDAQ 100 and the S&P. So you are going to see some cool-off pressure because of these medium-term. Look at this, short-term 94%, 50-day 97%. These are momentum overbought levels. But the 200-day is not that fast to move higher. Look at that. It's still below 50. And as long as it's below 50, the market is bearish. And when you take this into account, the 48% with 97, and the fact that this 50-day is going to move down, it's going to put pressure on the 200-day line. And that's telling me technology and consumer discretionary, the top sectors in the NASDAQ 100 and the S&P 500 are due for a minor correction. But healthcare, I'm not seeing that. I'm actually seeing more upside in the healthcare sector. And one of the stocks that I'm looking in the healthcare sector is Danaher. All right. See, indices, S&P healthcare sector, global science technology innovator, help customers solve complex challenges and improve quality of life around the world. Like right now, look at this. The 1-year return is 28%. Not bad. 3-year return is 100%. 5-year revenue growth is down a little bit. But the 5-year dividend growth is up 70%. That is substantial. Now, stock is priced right now is at $170. If we look at our analyst ratings, you will see that the stock has 10 strong buy recommendations. That's very, very positive. Only 2 moderate buys, 2 holds, but 10 strong buys. That means institutions are looking at the stock and look at the price action. I mean, the high price target, $190 a share. It's at $169 a share. Also, if you look on earnings estimate, you will see here that earnings surprises, all last 4 quarters, we had positive earnings surprises. When you take positive earnings surprises and you take analyst expectations and you see 10 strong buys, that's a magnet for institutional investors. Now, why do I really like this stock right now? Let me show you. If you look at it technically over the last 6 months, notice it pulled back, it went back up, it took out the highs, and now it's consolidating in a round top. I like these round tops. These round tops are consolidations. The stock was so strong it couldn't even bounce back, and now it's near all-time highs again. So here is what I would do. I would wait for the price of the stock, DANHER, or ticker symbol DHR. I would wait for it to trade right above the 170.70 level, 170.70 level, or 170. How about a $170 How about $171 level to make it really simple on a stop, or put an alert if you're trading options. Put an alert to buy the stock at 171 on a stop. Now, if you're trading options, you don't want to buy the stock when the alert goes off. You want to go to options. And again, we're looking at the 171 price. Let's look at option prices. This is a breakout trade, which means we want to buy ourselves some time. Let's see, 107 days is fine. Now, we're not going to hold it for 107 days. If it doesn't do anything in 2 weeks, we're going to dump the stock. Let's look at strike prices. How about the 175 strike price? It's going between $7.30 and $8. You'll probably be able to get it on that breakout right around the $8 range. I would go with this option because it has the most open interest and the most liquidity for within range. Now, you could buy yourself some less time. You can buy this one that expires in 44 days. And that time premium, the time premium between 44 days and 100 and something days is about $4. But I would only hold the stock. If you're going to buy the stock, I would only hold it for 2 weeks. You don't want to hold an option that has less than 30 days till expiration. So in most likelihood, I would want to buy this one. And if it doesn't do anything by the time this option has about 85 days till expiration, I would dump this option. Again, you'll be paying about $8.50 for it because you're buying it on a breakout when the stock goes to the 171 level. And again, the reason why I like the stock is I think health is going to stay up while technology and consumer discretionary, which are really the same sector, or they have a lot of crossbreed, are going to move a little bit lower. But healthcare, we've got a lot of government funding coming into it, and a lot of ETF, a lot of hedge funds are buying healthcare ETFs because they have a lot more recession-proof qualities than technology right now, especially since we don't have a vaccine for COVID-19. So again, if you're looking to buy the stock, I would buy the stock near the 171 on a stop. I would put a stop loss at the 155.10 level. I would probably give the stock 2-to-1 because it's pretty pricey right now. But the reason I like it is because we're seeing a congestion and consolidation. And when you see a trending range and then a consolidation range, that usually lowers your risk and the stock is setting up for more upside. Remember what I say, stocks usually go through two different motions: upside, congestion, upside, congestion. So again, buy at 171 on a stop, or if you're using options, you want to buy the 175 strike price. That's expiring in about 107 days. Your stop loss is about a 155. If it breaks 155, 154, I would be getting out of this stock. And if you're buying the option, I would go with the 175, and I would only hold it for about 2 weeks. If it doesn't give you profit within 2-3 weeks, it's probably just going to go back into this range and continue consolidating, and we don't want that. So what I wanted to do today to give you the full A to Z analysis of how I look at sectors, how I look at stocks, how I look at stop losses, so forth and so forth, so forth. If you trade the stock, that's great. If you don't, that's fine too. The key here is for you to get inside my head and be able to analyze the market and see it from the same perspective as I do and start incorporating the same tools in your trading. Now, due to extensive shutdowns and rising unemployment rates, many Americans are nervous about how to cover their monthly expenses, of course. I mean, look at these unemployment numbers. I mean, this is crazy. This is crazy. But there's a way around it. The ultimate insider spy, and I mean the ultimate insider spy, Lance Ippolito, he's revealing the strategy that allows the little guy to cash in on certain stocks just like the big banks do. And he's showing how everyday folks can create weekly paydays of up to $4,946 or even more. Now imagine you can make a weekly payout of $4,946. Now that would, I imagine, would cover some of your, or more, or most of your monthly expenses, right? Well, Lance is going to help you do that. Click the link below or the button at the end of this video. Get in on what Lance Ippolito is doing. Lance is one of the best traders that I know. Folks, weekly $4,946 a week, that's almost $20K a month. You don't want to miss this out. Learn about the ultimate spy. Lance Ippolito will show you how to make money in this market. I'll talk to you soon. Again, follow the link below or click the button at the end of this video. do it now.